Eveillard, a living legend of the investment world, is with us. Welcome to the program.
Thank you.
It's a real honor to have you here and learn from you. You've been in the business for decades, have amassed one of the best records in the business. A lot of value investors these days struggle with how to make sense of what's going on in the world. How has, in your view, value investing changed over the decades, and what has stayed the same?
Right. I think for several decades, value investors decided that they saw themselves as entirely bottom-up. That what they wanted to do was to look at particular businesses, try to figure out whether they could understand the business, and if they understood the business, thought they understood the business and liked the business, whether the stock was available at a reasonable price, in which case they would buy it and patiently wait for the stock to go up. And it served them well for decades until in 2008, in the midst of the worst financial crisis since the Great Depression, many value investors went down 30, 35, 40, 45% in 1 year. Now, admittedly, it's only 1 year, and many of them recovered very nicely in 2009. But I think a key question today is whether we are still in the post-World War II economic and financial landscape, in which case it would be appropriate to continue to be entirely bottom-up as a value investor, or whether we are in a new, so far undefined, possibly threatening landscape, in which case one should continue to spend most of one's time doing bottom-up work, but meanwhile one should keep an eye on the top-down.
And when it comes to the top-down, what worries you the most? What do you think has become the biggest challenge to preserving purchasing power over time?
I think from the top down, it seems to me that the best analysis of the recent and continuing financial crisis is provided by the so-called Austrian school, which, among other things, pointed out in the 20s that if it's not enough to have overall prosperity and apparently low inflation, that you have to be very careful not to let the credit boom go on too long and be too strong, because a credit bust would eventually follow a credit boom, just like night follows day. And indeed, that's what happened in the late 20s, and again, that's what happened between, say, the early 1980s and 2006, 2007. So recently, we had basically a 25-year credit boom, interrupted, in the early 90s already from a real estate point of view, and then around 2006, 2007, the credit boom turned into a credit bust. And the Austrians also say, if you've been stupid enough to have a credit boom and then a credit bust, you have to be very careful not to try and patch things up in the short term, because you may stabilize matters in the short term, but you may in the process compromise the medium and long term. And today everybody seems to be a neo-Keynesian, but it doesn't seem to work. An enormous amount, if you look only at this country, an enormous amount of both fiscal and monetary stimulus has been in place since 2008. Yes, it stabilized matters, but the recovery has been weak by historical standards. And the truth is, Keynes was a brilliant writer. He was the king of the seductive paradox, but in the end, he was a quack. And whenever I say that in public, I sense that there is a gasp in the audience. But I think already in the 70s, neo-Keynesian remedies had been discredited, and I think they're going to be discredited again.
Isn't it interesting how even in the US then people seem so willing to rush to the government for solutions and rely on the government, given the experiences with socialism, communism around the world. Do you think that even this society is much more fragile than is perhaps widely accepted?
Yes, I mean, to a lesser extent, admittedly, than in Europe, this is a country where politicians have made too many promises which they can no longer keep, really. But it's hard on the politicians because they made all these promises. They find out that they cannot really keep them. That either taxes have to be increased in a major way, or government spending has to be reduced also in a major way, or both. And so that's where the tensions, I think, are appearing in the society.
What do you make of the record low interest rate environment in all the major economies in the world? What distortions does that lead to?
I think it's going to create tremendous distortions for a very simple reason. Money is not supposed to be free. And money, for all practical purposes, is free. People say, oh, yeah, but there is no inflation. Well, again, going back to the Austrians, inflation to the Austrians, and I think they're right again, inflation is not the increase in the consumer price index or the increase in the prices of various assets. Those are only symptoms of inflation. Inflation is the creation of too much money and too much credit. And indeed, as you probably know, in 1980, the consumer price index was changed. Major changes were made to the consumer price index. And there are some people who continue to compute the consumer price index as if no changes had been made in 1980. And they come up with a number which is not 2%, which is the current CPI index number. It's more like 6 or 7%. Now, I suppose that some of the changes made in 1980 were legitimate, but some probably were not. Particularly the idea of substitution, the idea that if the price of beef goes up, we will not include it in the consumer price index because we will assume that the consumer will substitute chicken for beef. Well, if you don't like chicken,
What is an investor to do then in this environment? Even in the investment industry, people are reporting nominal numbers. Customers generally don't even ask the question about real returns. They only find out in hindsight.
Right. Yeah, I mean, there may be in the future the matter of nominal returns may appear to be half decent, but real returns may be less than decent. But what's an investor to do is again to continue to because in a way, I think what we have is equities by default. In other words, the authorities, and Mr. Bernanke has been quite clear about it, he's trying to push investors towards equities. With the idea that, he's probably right, that if the equity market goes up, then the confidence of investors, the confidence of businessmen will be greater than otherwise. So I think the investor has to continue to do the work from the bottom up, and again, keep an eye on the top. Keep an eye on the top down in the sense that accepting that in the U.S. and in Europe and in Japan and possibly as well in China and in India, there is very little doubt in my mind that from a long-term point of view, the East is rising and the West is declining. But meanwhile, I think China and India, of course, there will be bumps along the road, and maybe that's what we're about to see. So that the investor should possibly recognize that times are, whenever Benjamin Graham, the founder of the Value School, was asked, what do you think will happen to company X or Y? What do you think will happen to the economy? He used to deadpan, the future is uncertain. And it's true, the future is uncertain. On Wall Street, you have all sorts of people who tell you on October 8 of 2013 the Dow Jones will be at 18,225. You're lucky if they don't give you the decimals. Of course, this is nonsense. Nobody knows. Only God knows, and He ain't telling. But I think one has to accept today that the uncertainties are even greater than usual. That where we will be 5 or 10 years down the road, nobody knows. And nobody knows in any case, but today I think nobody knows because there seems to be a risk greater than usual that things will turn out sour. And I mean, not forever, but may turn out sour, totally sour for a period of time. So one should be very careful about not overpaying for securities, for equities.
Are the uncertainties greater because of the amount of debt that has been accumulated over time, or are there other just as important factors?
No, the debt in the developed world, because in India and China and Asia in general, there is much less debt than there is in the US, in Europe, and in Japan. Debt is the excessive amount of debt is the major problem, right? And in a sense, I suppose it's because there is so much debt. Either, of course, the paradox is that if you take the U.S., the tremendous increase in federal government debt is associated with the deleveraging of the private sector. It's precisely because the private sector is reducing or attempting to reduce its debt that the state has to increase its debt in order to prevent the deleveraging of the private sector from resulting in a major recession or worse. Although, of course, the paradox is if too much debt is the problem to begin with, how can more debt be the solution, or more public debt be the solution? So yes, I think the excessive amount of debt is the major problem.
Now, Warren Buffett has embraced buying great businesses as the best of all the poor alternatives in an era of inflation.
Yeah.
Why do you favor holding a large portion of your portfolios at First Eagle in gold and cash?
Right. Now, incidentally, I'm now in a position of advisor, and I have been in a position of advisor for several years now. So I have no direct. I try to advise the best I can. I get along famously with my successor, but as you can imagine, there is a big difference between advising and doing. So I think gold. I'm the one who introduced gold into the portfolio. So far, Matt McLennan has continued to own gold, although, admittedly, below 5% of total assets, gold is irrelevant. Above 10 or 12% of total assets, gold becomes more than, I think it's the late Peter Bernstein who said gold is protection against extreme outcomes. So, whenever it looked like gold, which is a combination of gold bullion and gold mining stocks, was in excess of 10 or 12%, Matt McLennan, my successor, has sold a bit, which is absolutely fine with me. Because again, above 10 or 12%, it becomes something other than seeking protection. We look at gold as, and when Buffett says, and others who are negative towards gold say, but there is no intrinsic value to gold. What they don't seem to accept is the fact that we look at gold as a substitute currency. There is no intrinsic value to a dollar bill. A dollar bill is worth what the government says it's worth. So there is no intrinsic value to gold either, but gold is the only, has a history of being a currency, indeed up until 1914. Then so after 1914, the gold standard was softened. It was softened again after World War II. And then in 1971, Nixon, a Republican president, mind you, closed the so-called gold window, whereby you and I, as individuals, we couldn't exchange dollars for gold at the Federal Reserve or the Treasury, but a country that was holding dollars as foreign exchange reserves could present those dollars at the so-called gold window in the U.S. and get gold in exchange. And then Nixon saw that the gold was flowing out. He wanted to put an end to it, because even Greenspan, whenever there was a congressman who said, Greenspan, who I thought, and I said so way before I said so at a time when he was looked at as God, or God equivalent, I said he's going to end up as the worst chairman of the Fed since the Fed was created in 1913. Even Greenspan, whenever a congressman said, hey, why don't we sell the gold at Fort Knox and build a few hospitals with the proceeds? Even Greenspan said, hey, it's a currency of last resort. And that's the way we look at it. It's as a substitute currency, because I believe that neither the dollar, nor the yen, nor the euro, nor the Swiss franc, for that matter, are currencies that are trustworthy. Gold is the only currency that cannot be printed, so that's why we look at it. We look at it really as cash, right? As cash in a currency that cannot be printed.
And in terms of the cash position, does that indicate? I know you're not actively running the portfolios. How do you see the cash portion of the portfolio? Does that indicate perhaps that you're waiting for better opportunities?
I think Matt sees it the way I did, which is cash as a residual. We don't decide from the top down we're going to be 7% in cash, 18% in cash, 25% in cash. It's a residual. If we see plenty of investment opportunities, then the cash will not disappear, because we want to have some cash to handle redemptions if necessary. But if we don't see too many investment opportunities, and maybe if we don't see too many investment opportunities, it's because we are we pay a great deal of attention to valuations, as I said before. Maybe in today's circumstances, we should be very careful not to overpay for securities. So then if we don't see enough investment opportunities, and maybe we're not looking in the right places for all I know, if we don't see enough investment opportunities, then the cash builds up. And again, it goes down if we see investment opportunities. Right.
Can you give us some sense around this, one should not overpay for securities? That holds true always, doesn't it? So what does that really mean? Can you perhaps give us an example where that dilemma becomes very apparent in today's environment?
As valuations, we tend to use not price to earnings, but enterprise value to EBIT. Now, I'm the first to acknowledge that there is no perfect, there is no perfect way to place a value to a business. But we like enterprise value to EBIT because it introduces the balance sheet in the picture, which as value investors, we pay a great deal of attention to balance sheets. As Marty Whitman at Third Avenue says, we want the stocks to be safe and cheap, and by safe, he is alluding to the balance sheet. But as I said before, I think there are dangers lurking which did not exist prior to the 80s and 90s, prior to the credit boom, and so it's even and so valuations become even more important than usual. Now, admittedly, I think with the Buffett approach, the so-called margin of safety, with the Graham approach, the margin of safety is in the discount to the intrinsic value. The larger the discount, the better. And the intrinsic value is often, by Ben Graham, looked at as in a somewhat static manner, often balance sheet derived, not always, but often balance sheet derived. With Buffett, I think the true margins of safety may be more associated with the perception of the quality of the business, the perception of the quality of the moat, than it is with a discount. I would argue that from a theoretical standpoint, with the Buffett approach, one could buy an equity that, even though it may be selling at what we think is the current intrinsic value, with the idea that again, because the true margin of safety is in the perceived quality of the business, with the idea that the business will continue to create value in the future because it has a moat. Although, and indeed, I mean, for value investors, one of the great questions is, I believe, if we believe that a business has indeed a moat, and if the stock is bought with a discount to the intrinsic value, but moves to intrinsic value, should the stock be sold because it is selling at intrinsic value currently? Or should one, depending upon how confident, rightly or wrongly so, one is about the quality of the moat, should one accept that the stock might be temporarily, modestly or moderately overvalued, and continue to hold on to it, or at least to most of it, and sell? I mean, even Buffett said afterwards that he made a mistake when he didn't sell any Coca-Cola in the late 90s, when it became, vastly overvalued. But admittedly, Buffett always, in order to make a point, he tends sometimes to exaggerate, but he was once asked the question, when do you sell? And he said, almost never. And if it's indeed almost never, then it means that he accepts the fact that even if the stock gets to what he thinks is the intrinsic value of a business, if he has enough confidence in the business, the quality of it, then he's willing to hold on to it and accept that maybe temporarily it is what people would call sterile money.
Howard Marks talks about the importance of having reasonable expectations when it comes to investing. With the portfolio positioning at First Eagle, what return expectations do you have going forward? Nominal, or even more interestingly, in real terms? And how would that compare over 5-10 years ago?
I think we were never willing to put a number on expectations. When I took over in early 1979, what was then a $15 million fund, and today we run $50 billion, I thought I would try to achieve two objectives. One, which is an objective in terms of absolute return, to do better over time, and the key was over time, to do better over time than a money market fund, because we are subjecting shareholders in our funds to the risks of equities. And when I was mentioning that objective in the late 90s, when it was so easy for people who were aggressive investors to do much better than the money market fund, people thought, gee, I mean, that's not a particularly interesting objective. And then, of course, after the turn of the century, it became difficult to achieve that kind of of a return. And maybe I should have added do better over time than money market fund in real terms, in other words, after inflation. And the second objective, which is a relative objective, that I have to do better over time again than whatever benchmark is appropriate or my peers. But again, over time, because otherwise investors in our funds could say, hey, I don't need you guys, might as well invest into an index fund. So those were the two objectives, but again, we never mentioned any number.
With the trend toward compression of time horizons and a focus on short-term performance, we're seeing many investors, even those who perceive of themselves as value investors, emphasizing near-term stock price catalysts.
Right. They're wrong. They're wrong. I mean, I think number one, value investing, real value investing, number one, it makes sense. I mean, I remember when I first was exposed to, when I first came to this country, which was 1968, and because I was bicycling in Central Park in the summer of 1968 with two French students at Columbia Business School, and Benjamin Graham was no longer teaching there. No longer teaching there, he had already retired to California. But he was well known still at the Columbia Business School, and my two friends were not, their interest was marketing, it was not investing, but they knew I was a professional investor. So they mentioned the name of Benjamin Graham to me, and so I went to a bookstore and bought a Security Analysis, and more importantly, The Intelligent Investor, which, as you know, Buffett says is the best book ever written about investing. And so, and I was truly illuminated. And I spent the following 10 years trying to, and then I discovered Buffett through the annual reports of, through his letters to shareholders in the annual reports of Berkshire Hathaway, 10 years later in 1978. And I was illuminated twice, first by the Intelligent Investor and then by Buffett's approach. So number one, value investing makes sense, or at least to me. As I said, I was truly illuminated twice. And number two, it works over time. That was in 1984, the article in the magazine of Columbia Business School, and then 20 years later, the late Lou Lowenstein updated the Buffett piece of 20 years before, took 10 value investors, including, in the interest of full disclosure, our First Eagle Global Fund, and again showed that it was not 2 out of 10 or 6 out of 10, it was 10 out of 10 who had done much better than other investors over a period of time long enough to be significant. So number one, it makes sense, and number two, it works over time. So how come there are so few value investors? A few genuine value investors. And I think the answer is, there are several answers, but I think the major answer is psychological. If you're a value investor, you're a long-term investor. It goes back to what Ben Graham said about the fact that short-term the stock market is a voting machine and long-term it's a weighing machine. And if you're a long-term investor, you accept in advance that every now and then you will lag because you're not trying to keep up with your peers in the short term and you're not trying to keep up with the benchmark in the short term. And to lag is to suffer. Suffer psychologically. The late 90s, in the 80s and the early to mid 90s, we had lagged maybe for 6 or 9 months, moderately every now and then. In the late 90s, I lagged in a major way for 3 years in a row, 97, 98, 99. And what happened was that after 1 year, investors in our funds were upset. After 2 years, they were mad. After 3 years, they were gone. I lost in a fund I had run since 1979, so it had a long-term record. Between the fall of 97 and the spring of 2000, 7 out of 10 shareholders abandoned us. So you suffer psychologically, you go home, you think I'm an idiot. What is it that everybody else seems to be seeing, which I don't seem to be seeing? suffer financially in terms of bonus, or even worse, losing one's job. And that's what Jeremy Grantham alluded to in a recent piece where he talked about career risk, which is not something that's that people should be ashamed of. I mean, if you're in your late 20s, early 30s, you have a wife and 2 kids, the idea of losing your job is career risk is a legitimate worry. But that's what it is, it's career risk. So I think the value investors who try to see catalysts and who pay a great deal of attention to the short term, they're wrong. I was at a wedding last year where Seth Klarman of the Balpos Group was at the wedding too, and I was sitting at his table. And Seth told me that he had 2 advantages, he felt, over other professional investors. One, which is an advantage I think I also have, and genuine value investors also have. It has to do with the fact that, as I said before, value investing works over time. Seth said 2 advantages. 1, I'm a value investor, a genuine value investor, and 2, it's an advantage which very few investors, including value investors, have, which is because he's not in the mutual fund business, he's in the hedge fund business, and because he's been so successful over such a long period of time that his fund, now that he owns 25 billion, is closed most of the time. But every now and then he reopens it when he thinks he sees investment opportunities. And when he reopens it, he said, he decides who comes in and who doesn't. In other words, he achieves what I think other investors very seldom achieve, which is a coincidence between how he sees investing and how the shareholders in his fund see investing. So the odds that shareholders in his fund will abandon the fund because he's lagging for a year or 2 are probably very modest.
But that is good news for genuine value investors who manage just their own money, because they have that same advantage.
That's right. I always thought that it was, now that when I was working full time, I didn't really have a personal account because I didn't want to spend my weekend working on my personal account. But now that I have been in a position of advisor for 3 years, I've had a personal account because I already have substantial investments in the First Eagle Fund. And I'm finding it much less difficult to invest for my own account than I did to invest for other people. Even though with a mutual fund, I don't know. I mean, we have, I think, more than 1 million investors in our funds. I know maybe 4 or 5 of them. I've met 4 or 5 of them. So, and it's less difficult to run abstract money than it is to run the money of people. I've always refused. I have 4 brothers who live in France. I've always refused to give them advice because it's too difficult to advise family and friends.
Well, then talking about not First Eagle, where you don't actively manage money anymore, but your personal account.
Okay.
I'm curious, could you share with our audience where do you see then the biggest inefficiencies today? What about Europe? It's in the news, there's so much noise. How do you make sense of what's going on there? Where do you see the best opportunities? Where do you see value?
Right. It's true that the American market over the past 12 months or more has done much better than particularly in view of the fact that the euro has been weak. In dollar terms, has done much better than the American market, has done much better than the European market. At the same time, there is, I believe, a real problem in Europe. And it's a problem which goes back 12 years. There was an original flaw And indeed, the euro appeared, the euro was created for political reasons more than for economic reasons. The idea that that a full integration of Germany into Europe required the euro. And the flow was, of course, associated with the idea that there was a single currency, but at the same time, it was still the national governments and parliaments that had the responsibility, direct responsibility for the power of the purse, for government spending and taxes. So, so there was a flow. I mean, the flow was not apparent for 10 years, almost 10 years, and then to a large extent because of the financial crisis, the flow became obvious. And in essence, the only ultimate solution would be to correct the mistake that was made 12 years ago and have a European government. That the idea that you can have a single currency, like in the United States, if you have in the US, a federal government, that you would have a European federal government. That France would be like Massachusetts, and that Italy would be like, I don't know, Florida. But there is no appetite today, particularly in view of the fact that times are difficult in Europe. There is no appetite on the part of the French or the Italians or even maybe the Germans for a European government. No, but the idea of giving up some of the sovereignty is unpalatable. So there is a major problem, and yes, the Italians and the French and the Spaniards can push around the Germans somewhat successfully, but it seems they seem to be simply buying some time. They buy a few months and then they're in the soup again. So there is a major problem, but it's true that equities have declined, and now have equities in Europe declined to the point where they have become attractive in spite of the fact that the European problem seems to be far from resolution. Well, I think one has to take into account that because most European countries are fairly small, many of them have interests that go far beyond Europe. There are many, European companies that do a lot of business, not only in the U.S., but also in Asia, including in emerging, China, India, and South America, right? So one should not say, and I think some investors are saying, I don't want to look at European equities, period. I think one has to insist on modest valuation, but I think some European equities are worth looking at.
And some value investors then tend to gravitate to the great businesses, seeking safety,
Right.
Avoiding the eye of the storm in Greece, Spain. Do you see more opportunity in the core European markets, or actually where the eye of the storm is?
I think because most genuine value investors, one reason why Buffett waited a long time before he invested in foreign equities. And I remember Walter Schloss. I was at a dinner with Walter before he died a couple of years ago, but he was already in his 90s. And Walter told me, I've never bought foreign equity. And I said, why, Walter? He said, well, I don't trust
foreign accounting. I need my 10Qs, my 10Ks. I need, the SEC, etc. I don't trust the accounts of foreign companies. And the dinner took place where I was and he was, took place before Enron. And when Enron happened, I said, Walter, funny things also happen here. So still, genuine value investors, they are more comfortable analyzing a business than trying to figure out the political or overall economic risks, and that's why value investors were for a long time very reluctant towards so-called emerging, market securities. Worries about the accounting. Today in China, for instance, I think most genuine value investors hesitate before investing in China because there have been so many scandals about, the accounting. So I think genuine value investors are more interested in where the top-down does not intrude in a major way. Although I suppose there are exceptions, there may be Spanish or even Greek securities, for that matter, that have declined so much that the risks associated with those businesses seem to have been taken into account.
Could you share with our audience one or two names in Europe that you find are where you feel most comfortable?
I'm very reluctant to talk about names because it would probably be a name that is in First Eagle funds. And I think Matt McClendon, my successor, is very reluctant about talking about mentioning names. So, but I think one way to look at it is to say, particularly because of the dangers that are possibly lurking, I think a great deal of attention should be paid to so-called quality businesses. Now, one has to be very careful because the world is changing fast, and quality newspaper businesses used to be quality businesses, and then the internet came, and all of a sudden the newspaper businesses. It's not just that they were no longer great businesses; they were not even good businesses. So one has to be very careful about not taking it for granted that a good business model is forever. But if the business model appears to be good and in the lasting sense of the word, then I think the preference should be given to those businesses. In any case, the alternative would be so-called Benjamin Graham type stocks. And frankly, except among small equities in Japan, small stocks in Japan, there are very few Benjamin Graham type stocks available today. Well, not just small stocks in Japan, small Japanese stocks, small stocks in general, and particularly in Japan, there are. It's true, there are Ben Graham type stocks available, but not among big stocks.
Talking about Japan, again, a lot of people who call themselves value investors dismiss Japan. It's very easy to dismiss it with just saying corporate governance, and that's the end of it. First Eagle has had investments in Japan.
It's my fault,
long time,
and we've not been particularly successful with those investments. That's true.
However, what is your case then for investing in Japan today? Are you more encouraged by certain things? Has anything really changed there?
Well, not from the top down, although I think that the Japanese people tend to be very patient people. And they resign themselves to what has happened to them over the past 20 years, which is economic stagnation and benign deflation, which is the price they paid for the fact that their boom in the late 80s, which was both a real estate boom and the stock market boom. Indeed, from a stock market standpoint, I think the Tokyo stock market in the late 80s was the only stock market, in my experience, which goes back 50 years, only stock market where I thought if I looked at 10 or 15 or 20 stocks, I would not end up buying one. Usually, I've always found investment opportunities in practically any equity market, except the Tokyo stock market in the late 80s. And indeed, I think the success one sometimes has as an investor is sometimes due to what one does not own. And in mid-1988, I sold our last Japanese stock, which proved to be 18 months and 30% too soon. The Tokyo stock market managed to go up another 30% after I sold our last Japanese stock. And so at the end of 1989, but that was already true in mid-88, the Tokyo stock market was overvalued in a gigantic way. And same with the real estate market, since the time came in the late 80s when the supposed value of the imperial palace and gardens, which admittedly is quite a few acres right in the middle of Tokyo, but we're talking about a small, relatively small space, was supposed to be worth more than the entire real estate in California. It was a gigantic boom. And American economists make fun of the Japanese, saying, look, at the past 20 years, I mean, it was economic stagnation. The real question to my mind is, was that an excessive price to pay for the fact that they had had a gigantic boom that turned into a bust? But the natives are getting restless since there has been 6 prime ministers in Japan over the past 5 years. They changed prime ministers now more than once a year. And I think the only way out for Japan may be for them to inflate. So, but it may or may not happen. But what we have continued to see is the fact that from the bottom up, there are in Japan some truly world-class businesses, which sell at very reasonable valuations because of the top-down risk associated with Japan in the minds of investors.
And how do you then get around the argument that, or do you get around the argument that is often then mentioned, well, there may be value there, stocks are clearly cheap statistically, but how will you get that value?
Well, it reminds me when I was buying small continental European stocks in the 80s. Every now and then I was talking with a money manager in Paris, and one of them said to me, you're buying those small, French stocks. If we, the French, don't buy that stock, it will never go up. And admittedly, it was a trade-off. In other words, the valuations were ridiculously low in some instances, because at the time, and that's still true today, most professional investors who tend to, in France, to work for banks, although it's changing a bit now, or for banks or for insurance companies, where I think what Keynes said about the fact that it's better to fail conventionally than to succeed unconventionally applies. the most professional investors, they trade the big stocks in the index. They trade in and out of the big stocks in the index, paying a great deal of attention to the benchmark in the short term. So, yes, I mean, if the French investors, and particularly at a time in the 80s where we were not exactly alone, but except for a few British professional investors who were dabbling in French small stocks or German small stocks, there were very few Americans. We were among the first to invest in a major way in continental Europe, in small stocks in continental Europe. And so the trade-off was the stocks are ridiculously cheap, we will make 2, 3, or 4 times our money, but we will have to be very patient. And that's exactly what happened. We had to be very patient, but eventually we made 2, 3, or 4 times our money.
And when it comes to...
I think there's the same possibility in Japan today.
When it comes to selecting Japanese equities, what are your then key criteria to look for?
We are particularly attracted, with exceptions, we're particularly attracted to the stocks of Japanese companies that have been successful outside Japan and do quite a bit of business outside Japan, because some of them are truly world-class. I don't know whether you're a bicyclist, whether you have a bicycle, fine. But Shimano, the bicycle is a strange consumer good because the real brand is associated not with the bicycle brand, but with the bicycle parts, the brand of the bicycle parts. And for pedals, for brakes, for gear shifts, Shimano, and indeed the name Shimano is on the part. Shimano truly dominates good quality bicycle parts throughout the world. You have Fanuc, which is known for its robots, but which in fact should be better known for the fact that they do software for machine tools. So you have what I call world-class businesses. We're partial towards those, particularly since in those cases management seem to be more open because they operate successfully outside Japan. They seem to be more open.
However, when we look at the valuations of these companies, they don't come as statistically cheap as the other ones. So is that your message then, perhaps to not seek the largest discount in Japan, but seek a more moderate discount?
Well, if you apply the price, the thing is, and even with Japanese companies that have been successful abroad, they tend to sit on a ton of cash. And the enterprise value to EBIT, with price to earnings ratio, you don't take the cash into account. With enterprise value to EBIT, you take the cash into account. And on that basis, there are Japanese companies that are not that are reasonably valued indeed. Particularly if one thinks, rightly or wrongly so, that they're world-class businesses. Right.
What do you make of aggressive investors, the activists, so-called, who try to shake up corporate Japan? Are you sometimes tempted to pursue a more active approach to get to the value?
Yes, we don't, because the Japanese, one of my former associates, unfortunately he left us, but who was a very good in-house analyst. It was not Japan, it was Korea, South Korea. But it applies to Japan as well. He tried to point out, and it was a South Korean company that was run and controlled by a family. He sent them a letter, and the stock was extraordinarily cheap.
sent them a letter explaining to them why they should do a stock buyback, explaining to them that if they did a stock buyback, it would not only benefit us, but it would benefit the company, the management, the owners, the family that control the business, as much if not more than it would benefit us. So he sent a letter which explained in detail. He never got an answer. He never even got an acknowledgement that the letter had been received. They just don't want to listen to advice being given by a foreigner. And the same with Japan. So, Steel Partners, what's his name, Warren Lichtenstein, he was very active in Japan for a while. He's no longer is, because he didn't get, I think he got some, we owned the stock where Warren Lichtenstein was successful, because it was, and I thought that, because it seemed to be the perfect deal, because it was a case where it was a former textile business, but the Japanese don't run textile businesses. They stopped running them 30 or 40 years ago. It moved to other countries in Asia. And so it was a case where they owned real estate. They had redeveloped the real estate because they owned the land and some buildings, redeveloped the real estate. They owned a ton of cash. They had a business which was not a textile business, which they held on to. They had built a portfolio of securities, and one could see that the stock was extraordinarily cheap, assuming that the company would be liquidated, and taking into account the taxes that would have to be paid if the company were liquidated. And what Warren Lichtenstein did is that he said to the management, look, why don't you distribute a big extra dividend, special dividend, getting rid of a good chunk of your cash. And it will be good for us, because as a result the stock will probably go up, which it did. It will be good for you, because you will continue to manage the company. We will leave you alone once the stock has gone up and we will have sold our holding. And it's exactly what happened. They distributed a big extra dividend. It pushed the price of the stock up because the value was being recognized. And Lichtenstein and we were able to sell the stock on the way up. And the management stayed with the business where they had held on to the real estate, to the company, to the portfolio of securities. They simply had less cash than they used to. And I thought the formula would apply elsewhere, but it didn't. For whatever reason, it didn't. Right.
Are those then, in a way, exceptions that prove the rule?
That's right. Right.
You've been a pioneer in international investing. What are your key lessons from investing internationally, and what to do differently than in the US?
Now, it's true. I mean, Walter Schloss was right. One has to be very careful with the accounting. I mentioned China, but for instance in Hong Kong 20 years ago, the accounting was truly dubious. They've made major changes. The accounting is much more reliable today in Hong Kong than it used to be. That's why if one buys the stocks of businesses that do most of their business on mainland China, one should focus on the stocks of businesses that are listed in Hong Kong, not in the US or in Canada. But the accounting is no longer true, admittedly. But in the 80s, for instance, the accounting in Germany and in Switzerland and in Austria could be extraordinarily conservative. I remember we bought the stock of Flughafen Wien, which is the airport in Vienna. And when we bought it in the 80s, we realized that the accounting was such that they were depreciating their runway over 10 or 15 years, I don't remember the exact number, while British airports were depreciating its runways over 100 years. The British were the opposite. I mean, the accounting was extraordinarily conservative on the part of the Austrians. The accounting was extraordinarily liberal on the part of the British. One has to be very careful about British accounting as well. Which is one reason, well, England, there are two problems with British securities. Number one, they tend to be less inefficiently priced. It's a little bit like in the US. I mean, US and British equities tend to be more, I don't believe at all in the efficient market hypothesis, but I think continental Europe and Asia to some extent tends to be more inefficiently valued than either England or the US. And as I said before, one has to be very careful also about British accounting. So accounting could be extraordinarily conservative in Germany, in Austria, and sometimes in Switzerland as well. But that's no longer true. But otherwise, I suppose there was a time when, say, in Indonesia, there was a political risk that one had to be, vaguely taking into account. Vaguely, more or less, probably in the sense that one didn't want to have more than 2, 3, or 4% of one's portfolio in Indonesia. But today, for instance, the political risk in Brazil, I suppose, is much less than it used to be. Same with Indonesia. Same with South Korea. Indeed, South Korea, I think, is no longer defined as an emerging country. So today I would say that investing internationally is I suppose less difficult and than it used to be. Why?
Taking your comments on Japan about the bubble and then the inevitable result that came, aren't there parallels to the US with the real estate bubble and what happened in the stock market? Are we in danger of following that path?
Well, I think the real estate bubble in Japan in the late 80s was even bigger than the real estate bubble in the US up to 2005, 2006. But I think again, the American economists who said, look at Japan, I mean, they botched it, they've had 20 years of economic stagnation. Well, as I said before, I would argue that at least, in spite of the gigantic character of their boom and then their bust, they managed to avoid a return to the Great Depression. And maybe the choice after a gigantic credit boom, gigantic bubble is either moderate pain over a long period of time or very sharp pain over a short period of time.
What is the single biggest mistake that keeps investors from reaching their goals?
I think I truly believe it is not being value investors. Admittedly, it's difficult not to pay attention to, everybody has a Bloomberg machine or something, not to pay attention to, daily changes in stock prices. In a way, if instead of investing in securities, I invested in buildings, in real estate, if you're an investor in real estate, if you own a few buildings, or if you own even one building, you don't worry about the price of your building on a daily basis because there is no daily transaction. It's less difficult to be a long-term owner if you own real estate or in general illiquid assets than it is with equities that trade, daily. Right. So I think the biggest mistake is to pay. It's not for nothing that Buffett is one of the richest men in the world. It's because he has, a very sound approach to investing. Now, it's not a recipe, it's not a formula. Of course, his enormous success is due to a large extent to his own extraordinary skills. But, when he wrote that article in 1984, it was in an attempt, which was a humble attempt in a way, to say that his own success, which was already obvious in the mid-80s, was due not just to his own skills, but also due to how sound his investment approach was. And I think most investors, including professional investors, have an investment approach, and maybe they cannot avoid it because there is, what Jeremy Grantham called a career risk, which is not, nothing to be ashamed of. So the mistake they make is to pay too much attention to the short term. Ben Graham was right. Short term, it's a voting machine. So you're in the hands of market psychology if you invest in the short term. If you invest in the long term, it's a weighing machine that weighs the realities of the business. It's like, the Frenchman who told me, hey, if we, the French, we don't buy that small stock which you own, it will never go up. Well, no, it's not true. It may go up after a long period of time, but it will go up if it deserves to go up.
And for those who do embrace value investing, of course, not many have achieved what Warren Buffett has achieved. So what is the biggest mistake that genuine value investors make that prevent them from reaching their goals? Is it that they succumb to that short-termism?
Or it could be that most value investors, including myself, of course, we don't have the skills of Buffett, and to identify a business with a sustainable competitive advantage, to identify a business with a sustainable moat is no easy task. That's why the Buffett approach is potentially much more rewarding than the Ben Graham approach, but indeed much more difficult because it involves judgment. It introduces a qualitative, while Graham relies mostly on numbers.
And taking that word judgment, it seems to be so lost today. Most investors seek an informational edge. How do you improve judgment? What about here at First Eagle? How do you foster an environment that's conducive to improving one's judgment?
When our younger daughter was 6 or 7 years old, somebody asked, do you know the anecdote already? No. Somebody asked her at school, what does your father do? And Pauline didn't have the answer, so that evening, when I came home, she said, she was embarrassed, so she said, hey, what do you do? What do you do? And I didn't feel like, particularly at the end of the day, I didn't feel like explaining to a 6-year-old money management, so I said, Pauline, I will tell you how I spend my time. And I said to Pauline, half of my time is spent reading, because I had read or heard that Warren Buffett was a voracious reader, which he is. So I said to myself, I don't have his skills, but if I read voraciously, maybe it will help me too, which it did, I believe. And the other half of my time I spent talking with my in-house analysts. And Pauline said, reading, talking, that's not work. I said, sorry, Pauline, but that's what I do. And by, what I mean by talking with the in-house analysts is that the way it worked, and I think it's still the same with my successor, is the in-house analysts, and incidentally, one reason where there are relatively few value investors, it's a secondary reason, but it's a genuine reason, is that the sell-side research is not very helpful, because most sell-side research is oriented towards the next 6 to 12 months, because that's what most professional investors are interested in. And the way you look at a business with a 5-year time horizon is very different from the way you look at a business with a 6 to 12 month time horizon. So the in-house analysts, they each cover a number of the stocks we own. They keep track of a number of the stocks that we own. Number two, they investigate the investment ideas that I had reading voraciously. And number three, I tried to make sure that there was enough time left for them to initiate their own investment ideas and develop their own investment ideas. Admittedly, I asked them to come to me before they would start doing some work on one of their own ideas. But I was very careful, practically never to say no. Although 1 or 2 years before Bear Stearns collapsed, one of the in-house analysts said, can I look at Bear Stearns? I said no. And not because I anticipated the collapse, but because I thought banks, including investment banks, I was old enough already by that time to remember the time when banks were almost like electric utilities. They were regulated businesses. They were stocks for widows and orphans. The stocks were high yield. They were high yielding stocks because the dividends were very important. The stocks sold at 10% or 20% above or below book value, etc. And I told the in-house analyst, look, I don't understand the banks today because it seems to me they are disguised hedge funds. And but generally, almost always, I said, yes, go ahead. And then it would be a phenomenon of back and forth. In other words, they would do the work, they would come back to me, I would have questions, and they would go back and try to find the answers to the questions I had. So it was back and forth. But I thought that the in-house analyst, I think it's still true today, had a better job than many in-house analysts at non-value investor shops, where the portfolio managers have a tendency to listen more to the analysts at Goldman Sachs or Morgan Stanley than to their own in-house analysts, which is, of course, discouraging. But because sell-side research, with exceptions, was of very little use to us, they didn't have that problem. And indeed, if I ended up buying the stock, because I was not about to redo their work, I may have had questions and there was a back and forth, but I was not about to redo their work. If I ended up buying the stock, their responsibility was at least as engaged as mine, in that respect.
You've talked about the importance of having temperament, the willingness to
Right.
follow your own path, if necessary, away from the crowd.
Right.
Can this human trait be learned, or is it innate?
No, I think, I don't remember whether it's Charlie Munger or Warren Buffett who said, either you're born a value investor or you're not. Either it appeals to you or it doesn't appeal to you at all. And I think it's true. I think it's not learned. It has to be part of your DNA in a way. Right.
When you look at the money management industry, the system of investment by agents rather than by principals has destroyed value for the ultimate owners of capital globally, of equity capital. If that's true, what do you think is a remedy? How do you view Joel Greenblatt's efforts with the value-weighted indices? Shouldn't that be more prevalent among the way the world's equity capital is invested?
Yeah, no, I like value-weighted indices better than one of the mill indices. Right, there's no doubt. Right. But I'm not sure I understand the question.
Essentially, what do you think is the future of the money management industry, where most professional investors actually do a disservice to their clients?
Right. Well, I think the one reason why we're at 50 billion today, I think, is that in the 90s, it was all about relative performance. If you were up 20%, but some fellow was up 35%, up 20%, they would get rid of you. The shareholder, your investors would get rid of you and move to the fellow who was up 35. Over the past 10 or 12 years, all of a sudden, absolute returns, as opposed to relative returns, have come into play much more. Because both institutional investors and individual investors can see that even if their professional money manager has done as well or even slightly better than the index, if the index, as was true of the S&P 500, was flat or more or less flat over the past 10 or 12 years, if you're a pension fund or if you're an individual who's saving for retirement, to be flat or almost flat over 10 and 12 years, in nominal terms, mind you, you say that's unacceptable. So there has been a tendency for some of that, some of the money of the 95% which are not value investors, to move to value investors like us. And it doesn't take too much money coming from 95% into 5% to make a big difference. So because we could show that over 10 or 12 years, we were certainly not up 40% a year, but we were up, 8 or 10% a year. Institutional investors and individual investors have had a tendency, maybe they're wrong, maybe the people are wrong, they had a tendency to move away from those who delivered an almost zero nominal return to those who delivered an 7, 8 or 10% nominal return. And also, of course, there has been the move from equity funds to bond funds, which I think is the wrong move that individuals are making. But, it struck me the other day that if you're less than 55 years old, and if you work in the government note, in the treasury note and bond market, if you're less than 55 years old, you've never seen a bear market. You've seen corrections, and sometimes sharp corrections, like in 1994, but in the fall of 1981, the 30-year treasury yield peaked at 15%, today it's 2.5%. I'm not saying that the bull market is over. I mean, there is no reason why a bull market cannot last longer than 31 years, but from 15% to 2.5%, obviously we're not in the second inning. So the individuals or institutions that are moving from equities to bonds today, I think it's a big mistake.
You've talked about value investing being a big tent. Where in that tent are you most comfortable? And what advice do you have to young people who are just starting out? They get value investing, but they're unsure whether to pursue more of a Ben Graham approach or more
right.
of a...
We started out on the Benjamin Graham side, first because I worked alone for 7 years. It was a catch-22 thing. I mean, headquarters I was telling headquarters, I need some help. They said, well, you're running a $15 or $25 million fund. We cannot justify giving you some help. You cannot justify you hiring some in-house analysts. I said, but then we'll never get to 100 million if I don't get some help. So it was truly catch-22. So I was alone for 7 years. But in a sense, I was lucky. As you probably know, I mean, luck plays a part in life. There is no doubt about it. I was lucky in the sense in the early 80s, early to mid 80s, there were plenty of Benjamin Graham type stocks. After the 60s, after the 70s rather, there were plenty in the early to mid 80s, still plenty of Ben Graham type stocks available, not just in the US but throughout the world. So I started out, with the Benjamin Graham type stocks. But then as we staffed up, as I was able to hire, several analysts, we move more towards the Buffett approach, and today we move more towards the Buffett approach, first because it's potentially more rewarding, although it requires exercising judgment, so it's less comfortable than the Graham approach, because there is always the risk that one's quantitative judgment be erroneous. So we move more towards the Buffett approach, so both because it's potentially more rewarding, and because as we grow in size, as I said before, today, Ben Graham type stocks, they are available only among small stocks, particularly Japanese stocks, but not among big stocks. So,
Jean-Marie, thank you so much for your time and all the insights.
it was my pleasure.